Hello, today, in less than 5 minutes, K&G International Advisors will inform you about the international financial markets. This week's report is titled, Economic Resilience Prevails Despite Late Summer Volatility. The final week of August delivered the kind of mixed signals that keep investors on their toes. Markets reached fresh highs midweek before pulling back slightly as traders positioned themselves ahead of crucial economic data. Yet beneath the surface noise, the fundamental story remains remarkably consistent. The American economy continues to show resilience in the face of persistent headwinds. The S&P 500 closed the week up 1.91% for the month, marking its fourth consecutive monthly gain. This steady climb reflects something deeper than seasonal optimism. Consumer spending rose in July by the most in 4 months, indicating resilient demand in the face of stubborn inflation. When households keep spending despite higher prices, it signals confidence in their financial position, not capitulation to inflationary pressure. The durability of consumer demand becomes even more impressive when viewed against the backdrop of monetary policy uncertainty. Wall Street traders refrained from making big moves before inflation data that could bring more clues on the pace of Federal Reserve rate cuts. This cautious positioning is understandable given that July's personal consumption expenditures price index showed inflation rising to 2.9%, the highest reading since February. Yet markets did not recoil from this news. Instead, they processed it within the context of a broader economic picture that remains fundamentally sound. Personal income accelerated 0.4%, rounding out a report that demonstrated strength despite the higher prices. When people earn more, they can afford to pay more, and the inflationary spiral that many feared has failed to materialize into the self-reinforcing cycle that characterized previous decades. The corporate sector continues to provide the bedrock for equity valuations. Corporate fundamentals have remained strong even as U.S. economic growth slowed decisively in the first half of the year amid concern about rising tariffs. This divergence between macro concerns and micro realities illustrates something crucial about the modern American economy. Companies have become remarkably adaptable. Trade tensions that might have derailed previous expansion cycles are being absorbed through supply chain adjustments, pricing strategies, and operational efficiencies that simply did not exist 20 years ago. The digital transformation that began during the pandemic has left corporate America leaner and more responsive to external shocks. Historical precedent offers reason for measured optimism as we head into the final months of 2025. Since World War II, whenever the S&P has notched 20 or more all-time highs by the end of August, the index was higher by the end of the year about 90% of the time, with an average gain of 5.5%. While past performance never guarantees future results, this statistic reflects the tendency of strong momentum to persist through year-end. The sustainability of current trends depends largely on the Federal Reserve's next moves. Markets appear to be pricing in a careful balance where monetary policy supports growth without reigniting inflationary pressures. The central bank faces the delicate task of maintaining economic momentum while ensuring price stability, but recent data suggests they may have more flexibility than previously assumed. Consumer expectations around inflation have remained relatively well anchored despite recent upticks in actual prices. This psychological component matters enormously because inflation can become self-fulfilling if expectations spiral out of control. The fact that households continue to spend and businesses continue to invest suggests confidence in the Fed's ability to manage this transition. Looking ahead, the September inflation data will provide crucial insights into whether July's UPTICK represents a temporary blip or the beginning of a more concerning trend. For now, the weight of evidence suggests the former. Economic fundamentals remain solid, corporate earnings continue to grow, and consumers demonstrate resilient spending power. The pessimists who have been calling for recession over the past 2 years may eventually be proven right, but their timing has been consistently poor. In markets, timing matters as much as being directionally correct. Those who remained invested through the uncertainty have been rewarded, while those waiting for the perfect entry point have missed significant gains. As we enter September, the message from markets remains clear. While volatility will inevitably continue, the underlying strength of the American economy provides a foundation for cautious optimism rather than defensive positioning.